Hey, JJ here with the Art of Value. So today I'm going to talk about Jim Chanos, an interview with him just in the last couple of days, a podcast that came up on my feed, and why he thinks some of the worst hit parts of the market still have more pain ahead. That's the headline there. But he talks about the last couple of years and what he thinks about what's going on and what's to come, which is a fascinating interview. And so if you're on Twitter, the usual, click one of the links to go to the full episode, because I just put a few seconds on here. All right, let's get into it. So yeah, he says in the transcript, Jim Chanos, why some of the worst hit parts of the market have still more pain ahead. And it was on the Odd Lots Bloomberg podcast. And it's a full hour, really fascinating. I recommend listening to it all because there's a lot in there that I'm not going to cover. So I'm just going to cover a little bit of it. I took some notes but didn't get through it all. And so Jim Chanos is Wall Street Cynic on Twitter too, by the way. And so if you're watching on YouTube video or Spotify video, if you find this interesting or with value, like and subscribe, hit the notification bell on YouTube and notification bell on Spotify and follow. And if you're on audio elsewhere, you won't be missing anything because this is mostly just transcript. So, co-founder of Chanos and Company he is, and one of the most famous hedge funders and short sellers on Wall Street, if you don't know who he is. He's been around for a long time, about 4 decades. When you talked in the interview about going back to 1980, and so, interest rates being a factor in the 1980s. But he starts off saying the Ubers, the Grubhubs, etc. in 2020, if they are not making money now, when everyone is stuck at home, then they will be going to make, when will they be going to make money? When everyone is buying online. So he said that in 2020, the interviewers asked him, he was saying that, he says, what does he still think now? And he said the darlings of 2020 and 2021, Uber, the Lyfts, the DoorDashes, the unit economics were terrible at the time when they should have been nirvana, when everyone was getting checks from the government and restaurants were going out of their way to make deliveries, and they still couldn't make money. That's true, but also, what made me think there is that's true with the food delivery, with Uber Eats and DoorDash and so forth, but nobody was taking rides anywhere. They were, but the business is way down. Anyway, so not the best example there, but there are others talking about gig economy companies. So narratives trumped everything in 2020, he said. If you had a story and you could spin it about the future size of the market and profitability by 2030, you could do a SPAC and go public. Profitability by 2030. And unlike the dot-com era, there was where those stories would get $2, $3, $4, sometimes $5 billion valuations. In this case, this time they had 20, 30, 40, sometimes even $80 billion valuations. That's why we called it the dot-com era on steroids. And I was saying that too. Like people were saying, it's not the same as dot-com. The companies now are a lot better than they were, and that's what Kathy Wood said as well. But the valuations this time were just incredible, absolutely incredible. Even though they possibly some will come out well, it just depends. So he goes on, setting aside the legitimate profitable companies, I'm talking about the companies at the end of the whip. That's what was so shocking to us, just how big people were paying for, in effect, for the option value that businesses would be worth possibly something someday, but the business model was unproven. That's the most striking thing in Silicon Valley versus 20 years ago during the tech bubble bust. How are you feeling right now? They asked him. Seems like some of the air has been kicked out of the valuation tires of these companies you have been criticizing and targeting. No doubt his shorting's been going better over the last 6 months. When he was criticized for shorting Tesla famously, people even made videos about how much money he'd lost and others shorting Tesla. And so, things didn't go well, but now obviously going better. So he said until 2019, retail was buying index funds and investing reasonably, but starting in the fall of 2019, everybody started to pick stocks and buy options, and you can see it in the price of Tesla or whatever. The high flyers really began to go in October 2019. They took a speed bump with the pandemic in March of 2020, but as soon as the Fed opened the spigots, it was back to the races. It really went on to the first quarter of 2021, which was a period unlike I've ever seen in my 40 years of being on the short side. It was the meme stocks. But what was really striking to me by February 2021, for a period, SPACs were raising on an average of $3 billion every night. That was equal to the US savings rate, which struck me as the height of absurdity. Of course, early February 2021 was the peak of like innovation stock. I'd like to say bubble because I think it was a bubble. When ARK peaked. And ARK peaked, and a lot of stocks started to go down. They've been going down ever since, pretty much. Thought the bottom was in, but ARK's nearly back down to the lowest of the low where it was. Most stocks peaked in the first quarter of 2021, he says, and our short performance hit its bottom there and really began climbing in the summer of 2021, even though the market made a new high in the fall. A lot of stocks began to falter. Then we began to see disasters like Peloton. Remember this when that started to go off the rails? Robinhood, DraftKings, stocks that were darlings were suddenly down 60, 70% on bad news. This was on perceived bad news. This was the market. That was as the market was peaking too in October, November of 2021. Doesn't seem like that long ago. What did you think about how far it could go with the gig economy companies? How far it could go down? For a money-losing financial usually trades slightly below book value. That's where the Chinese and European banks trade. That are profitable, that is, but people don't trust the numbers or the model long term. So I'd say the money-losing brokers, like Coinbase and Robinhood, he brought up Robinhood quite a lot, or it must have been short Robinhood, or some of the fintechs, which was another absurdity foisted on the market in 2020 and 2021. Those stocks are probably going to trade slightly below book value. For some of those companies, that is still a long way down. So he said, a question was, has something changed in investor behavior to get to this point? Have we seen this before, like in the tech bubble? So there was a lot of comparison to the tech bubble in this interview where and I think so too, I'm not saying it's exactly the same, but it definitely rhymes from what I can remember. Especially when, and Jeremy Grantham said it too, when this more speculative ones, high valuation, get hit first and then the broader market later, which is it's over a year later that the broader market's going down, and those speculative or emerging tech stocks are down 50, 60, 70, 80, 90%. I mean, it's happening, right? So he says there was a confluence of events. In the tech bubble, it was primarily tech. There was a lot of value stocks that held up pretty well in the ensuing bear market. One pocket of insanity based on the internet, and the recession was pretty mild. This time around, it was almost everything: cryptos, NFTs, cap rates, and real estate. One thing when people are not prepared for is interest rates being reset meaningfully higher, because it just hasn't happened in a lot of investors' lifetimes. It's going to be hard for a lot of investors to deal with. The market will not be able to handle 5 to 6%. It just won't. Interesting. So he thinks, if interest rates keep going up, there's going to be a lot more trouble. And it seems like they will. Unless inflation can come down fairly quickly. Question. If you mentioned in the fintechs, the gig economy companies, what else out there looks egregious? He says the whole cross section of REITs seem absurd to us. 3% cap rates, data centers, warehouses. We've got so used to feasting on these ultra low interest rates. Even CPG, consumer packaged goods companies, and utilities, all still trading at 25, 30 times earnings. That has been seen as defensive, but they have as much risk as the techs at this point, he thinks. That's interesting. CPG companies and utilities, and real estate as well. And yesterday I did that video with, with the knocking on the door of real estate, death knocking on the door of stocks, then crypto. It had been into the door with blood coming out with stocks and crypto, and now knocking on the door of real estate, the Grim Reaper. How long could things go? How low could things go? And what's most vulnerable? They wanted to ask him how low the S&P 500 was going to go, but he obviously wasn't going to predict that. I mean, you'd have to be nuts to want to predict the exact bottom and how low it's going to go. He says, I'm long the S&P 500 myself, just FYI. So we're long the broader market, but short a set of radioactive companies, but still short a set of radioactive companies. But this has been a golden age for the companies in terms of profitability and valuations. It remains to be seen if profit margins will hold up. They're at record levels. What's most overvalued to you? They continued. They wanted to press him. Any company that's earning low to mid single digit return on capital. Things like the real estate industry or a number of consumer companies, the ESG space like solar, where the unit economics are just crappy, but there's a narrative there. Obviously, climate tech narrative, and also perception of government putting a lot of money in. There's been a lot of support for it, which is true, but economics win out in the end. Where there's leverage, as there are lots of these names out there, it's going to be problematic if rates drift higher. Yep, leverage. Same with the GFC, global financial crisis. Anything with a lot of leverage just got devastated, and rightfully so. People keep saying this is the bottom, but what does it look like when the pain ends? They wanted to ask him. To use the 2000 analog again, I've been surprised just how much retail investors continue to want to speculate. That's one of the things that's kept me exposed on the short side. Cathie Wood was getting inflows for most of the first quarter. In some cases, record inflows, and we see it in the meme stocks too. People are still speculating. Every time the market stopped going down, the stocks would jump. This is in the first quarter, or pretty much up until now, really. So my shorts keep going up. That's exactly what they did in 2001 and 2002. People still want to believe this is the bottom, but I don't know. But the willingness to speculate is still there, and that's shocking to me. People are buying the most speculative stocks for a bounce, and then it goes up a little. It does bounce. This is me talking now. Goes up, bounce, and then another leg down. Bounces a bit low, another leg down. That last little rally, I think it was around 10%. It was a reasonably big one, but long bear markets do kind of just go down incrementally with it can be 10, 15 rallies, bear market rallies to the bottom. And so he's basically saying that once that stops, once people capitulate and just stop buying the dip or run out of money, really, then that would be the bottom. So that's all I got up to. That was like the halfway mark. So I might do another one of these because I did find it fascinating, even though I do find it fascinating what he has to say. He had a lot of criticism, and but it's playing out now. What he's been saying for the last few years. I know they talk about Tesla later on, so I'm going to talk about that. But he still short Tesla, still short. And what is it? As short would have been if you've been short Tesla since the beginning of the year. It's been working. It's down nearly. I think today it's 48%. It did touch 50 a couple of weeks ago. So, I mean, there's been I've noticed more and more stories, sort of bad news coming out about Tesla, about the FSD, and with questions about that and regulatory questions, or possible orders dropping off, even though they've got a lot of demand, they put prices up, so they've got pricing power. But I know Chanos in the interview says that, Tesla's not in danger of really going out of business. But I noticed that Elon Musk said in an interview the other day, with the Silicon Valley Drivers Club or whatever it was. I watched half of it so far. He basically said that, so many companies have gone out of business. Every car company's gone out of business or gone bankrupt at some point, except for Ford and Tesla. Obviously, Ford being much older. But he's saying that, car companies make money on their parts, high premium on parts, and can sell, not make a profit on the cars at all, which new car companies can't. They can't afford to do that, so they can be driven out of business that way. So I know car companies have been started and been successful, but he's saying he kind of joked or exaggerated by saying Tesla, if FSD, full self-driving, it needs it to be able to continue, to be able to, it could be worth a lot with FSD, Tesla, or zero, meaning that it could go bankrupt if FSD doesn't work out. So my thought is that it could take longer. I mean, he's been saying since 2014 that it's it can be 2 years, and it's getting better. But how much regulatory difficulties would there be actually rolling it out when it is successful, fully with no driver? You said there've been accidents of people being asleep and drunk or whatever, so having overconfidence. Anyway, that's getting into a different area. But so if you got any value out of this and enjoyed that, so like and subscribe on YouTube, Spotify, follow, or Apple Podcasts, or anywhere you get your audio content, and join me on Twitter at the Art of Value. All right, see you next time.